A municipality paid hundreds of thousands of dollars to a consulting firm that had no office, no employees, and no record of doing the work it billed for. The firm existed on paper, yet public money moved through its name. The first question was simple: who checked the vendor before the first payment was approved? The answer led to a procurement system built on trust, speed, and unchecked forms. One internal official approved the invoices without verifying the work. No site visit stopped the payments. No staff lists proved the firm could serve the municipality. No past work showed that the company had the skill it claimed to have. This is how a shell company can enter local government. It may have a legal name, a mailing address, and a bank account. That can make it look real in a file. But a shell company may have no true business behind it. It can be a paper door, ready to receive public funds. The darker term is ghost contractor. A ghost contractor is a vendor that appears in records but cannot show the people, office, tools, or work needed to earn its pay. The name sits in the system. The invoices move. The service itself may never take place. That gap is where procurement fraud begins. Procurement means the way a government buys goods and services. The rules are meant to protect public money. They call for fair bids, clear records, and vendor vetting. Vendor vetting means checking who a vendor is, what it can do, and whether it truly did the work. In this case, the records point to a failure before the money left the municipality. The firm was hired even though the basic signs of a real operation were missing. The issue was not a hidden flaw in a complex machine. It was a missing check at the front door. A real consulting firm should leave a trail. There may be workers, reports, work plans, past clients, and a place where staff can be reached. None of those facts, as described in the case records, supported this vendor. The firm held a name, but the name did not prove that a business stood behind it. The invoices became the next clue. They asked the municipality to pay for consulting work, but the internal process did not show proof that the work had been completed. There was no verified product tied to each bill. There was no clear record of who reviewed the work before approval. That is phantom billing. Phantom billing happens when a vendor sends a bill for work that was not done, cannot be shown, or cannot be tied to a real service. The bill may look clean, it may carry dates, amounts, and a company name, but a neat invoice is not proof that anyone earned the money. The official who approved the invoices became central to the paper trail. The records do not show a full team blocking the fraud. They show one internal decision point with power to move the bills forward. When that point failed, each approval helped the next one look normal. That is why shell companies can exploit local government procurement without a dramatic break-in. They use the system as it was built. A form is filed, a vendor is entered, an invoice arrives, an official signs, a payment is made. Each step can seem small, while the total loss grows in silence. The people who feel that loss are far from the invoice. Public money comes from taxes and local budgets. It is meant to pay for services that residents can use and trust. When a municipality pays a ghost contractor, the harm is not only an accounting error. It is money removed from a public need without a proven public result. The missing work also creates a second wound. Honest businesses compete under rules that cost time and money. They prepare bids, show their records, hire staff, and deliver services. A shell company can skip much of that burden if no one checks the claims. The process then rewards paper over performance. The scheme also depends on silence inside the file. One weak approval may be called a mistake. Several approvals can look like routine practice. That is why the records must be read in order. The first contract, the vendor file, the invoices, and the approval trail can show when care ended and assumption took over. A forensic examination follows that trail without trusting the surface. It asks who created the vendor record, who reviewed the firm's history, who confirmed the address, who checked for employees, who matched the invoice to actual work, who had the duty to stop payment. Each answer points to a control or to the place where a control failed. The vendor vetting process should have raised basic questions. Was there an office? Were there employees? Was there relevant experience? Could the firm explain its work? The case study says the answer was no office, no employees, and no history of relevant work. Those facts made the approval hard to defend as a careful review, yet the payments continued. That detail changes the story from a weak file to a working channel for money. The invoices did not need to prove much because the internal controls did not demand much. A control only protects funds when someone uses it, records it, and acts when the answer is unclear. The municipality's system may have contained rules on paper, but rules that are not followed become quiet decoration. A signature can show that a person approved a bill. It cannot show that the service was real. A vendor number can show that a company was entered into a system. It cannot show that the company had workers or completed a task. The audit finally brought the phantom billing into view. Auditors do not need a dramatic confession to find a problem. They can compare the vendor file with payment records, work claims, and proof of service. When those pieces do not meet, the gap becomes evidence that demands an answer. The audit findings shifted the case from suspicion to a documented failure. The issue was no longer only that a vendor looked strange. The record showed that public payments had been approved while basic proof of work was missing. The audit gave the paper trail a clear name. Money moved, but the service could not be verified. That finding also exposed the danger of delayed review. An audit often comes after the contract, after the invoice, and after the payment. By then, the public has already lost control of the money. The later discovery may explain what happened, but it cannot restore the time or service that residents were promised. The legal fallout followed the audit findings. Officials involved in the approvals faced legal action, according to the case record. The final result must rest on court filings and final rulings, not on rumor or assumption. But even before a court speaks, the record shows the cost of weak oversight. For the official who signed the bills, the key question was not only whether the vendor was fake, it was whether the duty to check had been ignored. Public office gives a person access to public funds, but it also gives that person a duty to protect them. A signature can become a shield, or it can become a trail. For residents, the story is harder because the loss can feel invisible. There may be no broken bridge to point to, no empty warehouse, and no failed machine. There is only a service promised in a contract and a payment made for it. Phantom billing hides harm by making non-work look like ordinary work. The shell company does not need to control the whole government. It may only need access to one gap. A weak vendor file can open the door. A single approving official can keep it open. Poor records can hide the path. By the time an audit finds the pattern, the system may have treated each payment as a separate routine act. That is the central lesson in this case. Procurement fraud is not made possible by a clever company name alone. It grows when internal controls fail to catch non-existent vendors, when officials approve invoices without proof, and when no one asks who did the work. The paper trail was there. The protection was not. A stronger process would begin before the contract is signed. The municipality would confirm the vendor's office, staff, experience, ownership, and ability to perform. It would check for conflicts of interest. It would require proof of work before payment. It would keep a clear record of who checked each fact and who accepted the risk. Those steps are not complex, but they must be real. A sole source bid needs a reason that can be tested. A contract needs work that can be seen, measured, or confirmed. An invoice needs more than a name and a number. It needs a link between public money and a service that truly reached the public. The final warning sits in the records, not in a slogan. A company can exist in a database and still be empty. An invoice can be signed and still be false. A local government can have rules and still fail to use them. When a ghost contractor receives public money, the missing work is only the beginning. The deeper loss is trust, paid for by everyone.